President Williams, always great to catch up with you, sir. And if you don't mind, I'm going to start the conversation with a quote of yours. You went on to say in the last day or so, from my perspective, we are quite a ways from achieving my interpretation of substantial further progress. So, President Williams, I imagine you anticipated this trillion-dollar question. What is substantial further progress?
Well, that's something we'll be analyzing. I'll be studying very carefully, looking at the progress we're making about getting back to maximum employment, and also our goals around a 2% inflation on average over time. So it's really looking at all the data, the indicators, and really seeing that actual achieve progress, both in terms of employment and also in terms of underlying inflation trends back to 2%. So it's really, looking carefully at all the data and indicators and assessing that to come to a conclusion.
President Williams, for the benefit of our audience on radio, as I asked that question, you smiled because clearly you anticipated it. I just wonder why keeping what constitutes substantial further progress vague is a feature and not a bug of policy.
Well, we are not following some mechanical formula for making monetary policy. We have to look at a wide range of information and different indicators. And we also have to think about where the uncertainties and risks to the outlook are too. So I wouldn't say it's vague. I think it's pretty clear. We've laid out very clear indicators about how we think about maximum employment and price stability. But there's no kind of a numerical threshold or something that we're looking at. We're really looking at the full set of data around these goals and taking into account all the extraordinarily high levels of uncertainty in the economy that we've experienced for the past year and a half, and we're continuing to experience as the economy reopens.
Well, John, there's a lot of uncertainty, but that stern taskmaster, Jay Powell, makes you write down your forecasts. And I'm just wondering, on the Fed spectrum from the Survey of Economic Projections, what you think growth will be this year and in 2022, and what you think PCE inflation will be.
Well, we're seeing great signs of the reopening of the economy in the past several months. So I have a pretty optimistic view of what GDP growth will look like this year. So my view is that growth will be about 7% on a Q4 over Q4 basis for real GDP, which is the best number. If if that forecast is true, that'll be the best number since 1984. So I feel very good about the progress we're making on vaccinations, on growth, supported by strong fiscal support. And so that's my forecast. And I see the unemployment rate coming down to around 4.5% by the end of the year, which is, again, really great signs of progress. Looking to next year, I think growth will be, GDP growth will probably be around 3 to 3.5%, slower than this year because we're not going to get as much of that reopening dynamic. And some of the very strong fiscal support we saw last year and this year will be ebbing next year in terms of its contribution to growth. I still see the labor market continuing to recover next year, and employment trending downward. In terms of inflation, I do see the very sharp rise in prices we've seen in the past few months is mostly temporary. So after inflation being at 3% or so this year, I expect both core and overall inflation rates to come back down next year to around 2%. As some of the reopening dynamics, play out, and some of these big increases in some of these prices, like used cars and things like that, subside.
Well, let me put it the way the Fed has always put it. If the economy performs as you expect, would it be likely that we would see you begin to taper in the fourth quarter of this year, or is that too early?
Well, it's really going to be driven by the data. Mike, I'm very data dependent in my views on policy. And right now we're still in the midst of just a really extraordinary and positive set of developments in terms of the economy, in terms of vaccinations and other things. So right now it's really about watching the data, seeing how quickly this economy can recover and get back to, to its full potential. And so any views I have about when we'll get to that point that we can start slowing the pace of our asset purchases, that'll be driven really by what's happening in the data, as I mentioned before, the kind of the risks that are out there in terms of the economic outlook, and doing it in a way, hope that really will be communicated very transparently and done in a very orderly way. So that's how I view that. The timings could be driven by the how the data evolve, and really my focus is on providing the appropriate amount of monetary support for a full and complete economic recovery, and with inflation averaging 2%.
Well, let's talk a little bit about what's appropriate. What do we get for $120 billion right now a month in purchases that we wouldn't get from less, given the state of the economy? And are you worried that the minute you announce that you might begin tapering, we get a taper tantrum? Does that keep you pinned in place?
Well, we really, in my view, we need to focus on getting monetary policy in the right place to support the very strong economic recovery and our 2% inflation goal. I think one of the lessons from the experience of the taper from years ago is the importance of not only getting the right decision and the right time for the decision, but also doing our very best to communicate that as transparently and kind of clearly to the public. I do think that this time we have a really strong economy in terms of the recovery, the pace of recovery. We still have a long ways to go to get to maximum employment, but we're on a very good track for that. And I think that in the context of a strong recovery and a very good economic outlook, then we can adjust monetary policy, hopefully without any undue market turmoil or things like that you just mentioned.
President Williams, Mike asked that question in a really polite fashion, so I'll be a little bit more blunt. Does this housing market in America need the Fed's support?
Well, obviously the housing market is one of the key drivers, along with consumer spending and business investment, of the strong growth. Now, my view is that the monetary accommodation that we're providing, both in terms of the very low Fed funds rate and also our asset purchases, is supporting overall financial conditions, really lowering the cost of financing for households, for businesses in general. It's not specifically targeted to the housing market. My view on this is we need to focus on our maximum employment and price stability goals, and as the economy makes a substantial further progress on those goals, we can make decisions around adjusting asset purchases and then further down the road in terms of our interest rates. So it's really my focus is on those goals, where it's not really about supporting or not supporting the housing market in particular.
Just a little hint from you there on what your view might be when it does come the time to reduce asset purchases, on the composition of that reduction. President, is there a bias to reduce, say, the purchases of MBS over treasuries, or what I'm hearing from you, maybe not?
Well, those are issues that we need to think about in terms of not only the timing of the adjustment of the purchase pace, but the timing over which that would happen, and also the composition of any adjustments that we make. So those are issues that we need to analyze very carefully and think through in terms of, again, achieving our maximum employment and price stability goals.
Well, you're talking about it right now because the chairman told us. So, President Williams, from your standpoint, what is the optimal approach to that conversation?
The optimal approach to the conversation around the asset purchases?
Yeah.
Well, I think we just, we do what we do the best. We analyze all the data, analyze the options we have in front of us, and really focus on the big picture of the goals that we're trying to achieve, the progress we're making on those, and how to best set our policy, instruments as we can to achieve those goals.
President Williams, forgive me for jumping in because you're too good at this. When it comes to the asset purchase program, do you view it as $120 billion a month, or a mix of purchases that need to be reduced independent of one another? Would you focus on MBS over treasuries, treasuries over MBS, or do you just look at the whole package that needs to be reduced equally? What's the optimal approach to that?
Oh, yeah. So, I clearly see the two supporting accommodative financial conditions broadly. So that's how I think about it, to your question. Now, do we have options in terms of adjusting them in different ways, the purchases of MBS and treasuries? Yeah, clearly we have options to do that. From my point of view, the main purpose of these is really to provide strong support for the economic recovery.
Well, John, if you do start the tapering process, do you go through tapering completely before you get to rate increases? Do you stop QE purchases altogether before you would consider raising rates?
Well, Mike, as you know, last time we had a sequence of decisions that were made around that. I think this time, clearly we've learned a lot from the experience of the slowing of the asset purchases last time, and then eventually the normalization of monetary policy. So those are lessons that I think are important to take. But this time is very different. The recession, the recovery are just very different from the global financial crisis because of the nature of it being driven by the pandemic. So I think it's really important that we don't sit here and just think what's going to happen necessarily a year or 2 years ahead and think through exactly all of those, but really watch the data, see how the economy evolves, and see how our policy decisions can best support the achievement of our goals. So those are issues that we'll obviously think about carefully, but also they're well off in the future, and we really should be based on how the economy is evolving rather than kind of where things are right now in June of 2020.
Well, let's talk about raising interest rates and your view on it. Where is your dot? Did you move it at the last meeting? Are you in 2022, 2023?
And you're not going to be surprised by my answer this time. So I'm not going to talk about my specific, view. As the chair, has said on last week, is that these are just projections based on a modal outlook. Each person comes into the meeting and has a view on that, and so I don't think really right now the key issue for the FOMC is when is the economy going to get to this point where we meet these these conditions that we've set out in the FOMC statement about time for the liftoff of the Fed funds rate. That's still way off in the future. Right now, really, I think the attention is on the taper. In terms of my own views, my focus is really on the framework. Is our new policy framework introduced last year I think positions us really well to deal with the situations that we're dealing with today and will over the next few years. And I think our FOMC guidance around the Fed funds rate is a very strong place to be. And that's, so when we get to that point where the economy is meeting those, conditions that we've laid out in the FOMC statement, I think that's when we'll get to the discussion about whether the Fed funds rate, what's the appropriate stance of the Fed funds rate. That's still, quite a ways off from today.
Well, if you won't tell us where your dot is, let me ask it this way. You were quite bullish yesterday in your speech. And yet we're still quite a ways from substantial further progress. Are we getting to that substantial further progress more quickly than you thought? Does the economy's speed surprise you, and is the inflation number to you surprising?
Well, let me start with the inflation. Clearly, recent inflation numbers have been very high. Obviously get a lot of attention from us and from everybody, and really we need to be very careful watching that data, seeing to what extent these are just transitory, temporary factors, or do they spill into kind of underlying inflation over the next few years. So clearly, inflation has moved up quite a bit. That's something that's part of the picture. In terms of employment, I do tend to go back to indicators like the employment to population ratio and the unemployment rate, and a lot of other indicators of the health of the labor market. And we have made progress for sure since December of last year, but that progress is I still don't think it's close to the substantial further progress that we set out on. And really, it's going to my views on this would depend on how the data evolve over coming months. Are we adding a large number of jobs? Do we see employment to population continue to move back up? And watching obviously all the other indicators as well. So I'm really focused on employment because that's what our mandate is. And are we making really strong progress towards the maximum employment goal that we have?
John, when it comes to the participation rate in the US labour market, do you have any conviction around what that looks like, how that progresses through the next 12 months? How unknown is that?
Yeah, that's obviously a really hard question. Participation changes for a variety of reasons. We've seen a lot of churn in the labor market in the past few months. People exiting the labor market, coming in. a lot happening with the reopening of the economy and all the events of the past year and a half of the pandemic. So I think right now it's hard to get a clear read on the underlying trends. I do tend to look at one category in the data, which is the employment population for 25 to 54-year-olds, which probably more in the middle of people's careers. And if you look back before the before the pandemic, that was over 80%. So I think that hopefully we can get back towards a number like that. But and for the overall population, we have seen some retirements from some older workers. So I think we'll have to carefully analyze that data to see if that's shifted the trend somewhat in terms of labor force participation. So I think we have to just look at the data carefully, analyze it, and come to our best assessment of what maximum employment was. Now, one thing I just want to say is we had an unemployment rate of 3.5% before the pandemic. We had very strong labor force participation, and I don't see any reason that our economy can't reattain a really strong labor market similar to that. It may be slightly different in terms of participation and some of the other issues, but it should still be an economy that is really a very strong one with maximum employment, again, with our 2% inflation.
Going forward from here, President Williams, as you know, you do get a lot of criticism over the current policy stance, and often the Federal Reserve will bring up the labour market, support the current policy stance. We had a story from the Wall Street Journal this morning on Blackstone agreeing to buy a company that buys and rents single-family homes in a $6 billion deal. This is Wall Street competing with Main Street for single-family homes. Is the Federal Reserve part of the problem when it comes to this?
Well, we're doing, conducting monetary policy, which is really about setting interest rates and supporting a strong economic recovery and our inflation goals. There's always developments in the markets that, or maybe they're affected somewhat by interest rates, but I think are really driven by other factors. And I just remind people too, when we think about why interest rates are so low and maybe how people are behaving around very low interest rates, I think a key part of this is that this is a structural change in the global economy. We have very low interest rates globally, not just because the Fed is holding interest rates lower right now to support the recovery, which we're doing, but even once the economy is fully recovered, we've achieved our goals. The neutral or kind of longer run interest rate is still very low. So I think just when we watch kind of things like this, we have to keep in mind that part of low interest rates is obviously intentional by Fed policy, but part of it is really a big part of the declining interest rates over the past few decades is driven by more structural things like demographics and productivity.
Usage of the Fed's overnight reverse repo facility has surged, hit a record yesterday, $765 billion. Why isn't that a signal that there is too much cash in the markets and you don't need to add more?
Well, the goal here is not to add cash to the markets, Mike. It is to, with our asset purchases, is to provide really strong financial conditions to support economic growth. An effect of that is that, that does our purchases of assets and other developments have been pushing, up the amount of reserves that would be in the banking system. Now, we created the overnight reverse repo facility, which you just mentioned, years ago. Specifically to make sure that interest rates are in the range that the FOMC set. So the FOMC has set a target range for the Fed funds rate of 0 to 25 basis points. And it's, we want to make sure that interest rates stay well within that range and not fall below it or not be above it. And so one of the ways that we do that is by, through the overnight reverse repo, putting a floor on interest rates. So what we're seeing here is, I think, of the natural operation of this kind of arrangements that we've set up to control interest rates. So, banks can hold reserves and do that at the Fed, and they offered, deposit rates and other services to their customers. Customers look at what the banks are offering in terms of deposit rates. They also look at money market mutual funds and other investments and think about where is it best to park their cash. So we see a natural movement between these two, especially with the large amount of reserves. We're seeing investors finding the money market mutual fund option more advantageous, and so we're seeing a lot more money moving the overnight reverse repo facility, and that has shifted over time. That's exactly how the system is supposed to work. Interest rates are well within the range, just as the FOMC wants, and we're not seeing any problems with market functioning or anything. It's working exactly as designed, and I'm not concerned about the large amount of overnight reverse repos. It's exactly what you'd expect given conditions in money markets. So this is I think a good sign.